Welcome to today's event, The Future of Oil and Gas, hosted by CFA Society Chicago's Education Seminars Advisory Group. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you have a question for our panel, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Tim Flannery, Managing Partner at Copia Capital. Tim has managed his family office under Copia Capital since 2016, investing in a wide range of public and private vehicles, including startups in a variety of industries. Joining Tim for today's discussion are Peter Keevy, Global Head of Energy at CME Group, Paul Sankey, Lead Analyst at Sankey Research, and Rob West, founder of Thunder Said Energy. I will now turn it over to our moderator, Tim.
Thanks for the warm welcome. Thanks to the CFA Society for hosting this and other really good educational programming. And thanks to Chris Vincent for the warm introduction. Today we're aiming for an oil-centric energy talk today. It's kind of complicated by the fact that oil is complicated, so we'll bump up into topics such as substitution, politics, policies, technology, and emerging social norms. The thematic name for the program is The Upside Down. It's both figurative and literal as it relates to oil, the oil price, the balance sheet in the industry, the supply and demand, the investment returns, and of course the geology are all pretty upside down in 2020. I'm really excited to have our three great panelists today. So after a quick introduction, I'll pose a question to each specific to their background. Hi guys, Peter, how are you?
Doing well, Tim, thank you. Thanks for the invite.
Awesome, thank you for being here. And Paul, are you in?
Yep, can you hear me?
Yep, awesome, thank you. Dialing in from Brooklyn. And from parts unknown in Ohio, Rob West.
Hello, hi, thanks for having me.
Hey Rob, thanks so much for being here. All right, Peter, we'll start with a little question for you before we get into the material. You've had a lot of different roles in the energy industry. You've been on the buy side as a trader and a hedge fund manager, and now as global head of energy for CME Group. Tell me what you've learned in that position that you would like to impart to your younger self, actually making trades and investments. And conversely, what has the perspective of having actually been there behind the screen, making the decisions, informed you about your customers?
Great question. I would ask, how long do I have? I've been in the industry for 30 years. I started as a, in the physical gas trading world. And I've had the very great fortune of learning from the bottom up, literally moving gas along pipelines, which is about as basic as it gets, to managing the futures business at CME Group, which is a great privilege. The one thing that I would point out is the energy industry is probably the largest and most significant industry, I believe, in the world. It touches almost every human on earth, and it is also one of the most unknown industries. And it's an industry of specialists. So what I would, my specialty was natural gas, and then it moved into crude oil. And I would say it's just endlessly fascinating, endless opportunities to learn. So for me, it's really about picking an industry that always evolves and offers new opportunities, either for investment or trading, new products. It's an ever-changing industry, and to me that was very exciting. Even though I sort of fell into it after college, it really took. So I would just urge everyone who's considering your career not to worry too much about where the future is going to be, and we'll talk about that a lot today, but just understand that the industry is going to be here for the rest of our lives, and there's always going to be new opportunities coming up, and you never know where they may come from.
Awesome, thank you, Peter. Paul Sankey, one of the things about your work, analysts are good at a variety of things, like 6 or 7. And one of those things that people can be good at is networking. And I always think that you've had a great, ear for what your network is telling you and what's different and what they care about. The question is, as you've moved from large investment bank and now you run your own boutique research firm, how has your network evolved and changed? And then also just comment on the state of play if you want to have a job in energy investment today.
Thanks, Tim, and thank you for giving me a much easier question than the first one. Well, obviously, I started the business in COVID, so I'm working essentially with an established network, that has been built up over the 20 years that I was on the sell side and the 10 years that I was at the IEA and Wood Mackenzie. What I would say is the general observation for the listeners is energy is complicated, as was just stated, and you'll never get to know all of it. It's just impossible. But I've always made an effort to work out who the smartest guy in the room is and to listen to them very carefully. So to work out who is the expert in any given area and then really make sure that you're listening. Ultimately, you get yourself ideally into a virtuous circle where you know people that you can talk to with other people about, and that becomes, a self-fulfilling positive dynamic in terms of networking. And then you have to awkwardly ask them for money.
That's awesome. Okay, Rob, we're going to mix it up for you in honor of Alex Trebek, a game show host in America that we lost this year. You can pick from two categories for your question. Okay, choose between famous American poets and areas of my academic expertise. It's up to you, Rob.
Well, I'm going to take famous American poets for 200, Tim.
Of course. Now, unfortunately, pretty much everyone has just left the meeting because of your choice, but don't worry about that. So Thunder said energy. Please tell me the story behind the name and kind of what it means to you, because you have a unique style of analysis and work.
Well, okay, so it is stolen from an American poet, T.S. Eliot, who wrote a poem called The Wasteland. And bear with me, please don't turn off the video call just yet. I was doing a similar job to Paul, running a sell-side research team and going around, talking to investors. And our industry is becoming a wasteland. You talk to people about investing in energy and they kind of seize up like you've, broached some unspeakable taboo. And, this is the most capital intensive industry in the world, in addition to being the most complex and interesting, as Peter and Paul alluded to. And if you pull out all the capital, we're not going to get an energy transition. We're just going to get a devastating energy shortage. And so, it really strikes me that if you want to avoid the energy system becoming a wasteland and you want to avoid even the world and the impacts of climate change becoming a wasteland, it's not going to be about, who can pull the most capital out the fastest. It's going to be about where do you put capital in? What are the things that you can put capital into that are going to earn you a return as an investor, that are technically ready, coming to the cusp of where they can compete for capital and can deliver us this, decarbonized energy system that we want to see in the future. And, to spoil the punchline, my lowest cost route to a net zero energy system is still using about 85 million barrels a day of oil and about 400 TCF a year of gas. So that's 3 times more gas than we have today. It's not the same industry as we have today. It's got to be the cleanest, lowest carbon oil and gas possible. It's got to be carbon captured and carbon offset. And I'm going to bore you with a lot more numbers around that today, but I'll stop for that.
There was your spoiler alert brings a nice segue. And I encourage the audience members to think independently as we introduce our first formal topic, which is what is the long-term demand for oil? How do you even think about how much oil the world will need, what it'll be allowed to use in the future, and what are social trends and policy drivers that will affect that? With that, we're going to bring up a poll question. So, okay, in 2019, global oil demand was 100 million barrels per day. Nice, convenient round number. In 2045, there are 4 different forecasts. Here are 4 different forecasts. There's many more. Which do you think will be the closest? A, 34 million, B, 57 million, C, 92 million, or D, 109 million. And these are from BP and OPEC, which seem like really unreliable sources. They're actually some of the better sources long-term. And Paul, while they're tabulating, I'm going to direct it over to Paul Sankey. Let's start with just talking about how wide this band of uncertainty is compared to history, and maybe without giving away the answer like Rob did, what is your personal band of uncertainty around oil usage in 2045? And forget about the point estimate. What is that range where you think is a reasonable range to talk about?
The massive problem with all these agency forecasts, the most well-known is probably the IEA out of Paris, but you also see them from the EIA, the US agency, OPEC, as you referenced, BP, Exxon, all do these things, and none of them have a price. So, you know, the fact of the matter is that the greatest realms of uncertainty surround what the price will be over that time period, and none of them actually name a forecast price, believe it or not.
Hey, Paul, can I interrupt for just a second? We'll go over the poll results and then get right back to it. So very few people think BP at 34 million with their zero emissions forecast is on target. 57, so roughly 57% of what we use today is 33%, but it's edged out by 92 million barrels a day, which is BP's business as usual scenario. And OPEC's base case of 23 is coming in second. Anyway, go on.
Yeah, so I mean, one price that BP did put in that forecast, which is where you get the 34 million from, was $250 a ton in 2018 dollars for carbon, which would be, you know, an enormous price, basically a doubling or tripling of all energy prices. And that's how you get to such a low demand number. Rob can talk very fluently about what he thinks the future price of carbon would be. And I actually spoke to BP about it, and they told me that many think that that price is too low, whereas I think it's insanely high. It's tough with carbon, very tough, because essentially it's a government mandated price. So that's going to make it very difficult, because essentially the government is going to be imposing a made up price for carbon. Rob might have a different view, but as best I can tell, the leading economies where you have a carbon price, which would be Europe and California, essentially it's just a government mandated price. And so then it becomes extremely difficult. And this is where oil energy becomes so fascinating, because you've got to overlayer governments which have a terrible track record of decent energy policy. So I tend to look at business as usual, which was one of the scenarios there, as the most likely outcome, given the track record of, for example, the US government in actually delivering coherent energy policy.
Yeah, I guess to build on that, you know, we've seen, I think, 3 major countries in the past 4 months put out net zero carbon standards, including China about a month ago, I believe, for 2060. And the thing that I would say is governments, particularly the US government, particularly in terms of policy, seems to do nothing, but actually has moved sporadically fast. You know, think about cannabis legislation, think about the tax change that Trump sort of did, and, you know, seemingly with little effort in 2016. Again, different makeup of Congress. But it just seems like a byproduct of the information world is you can have a rational policy maybe permeate, and we can't have social pressures. Do you see that on the horizon now? And then we'll.
Is that for me?
Yeah, you can take it and then maybe shuffle it around.
No, I think you're right. You do have fits and starts with these things, and obviously the Biden administration has come in hot and heavy with a climate change agenda. But if you look back at the past 10 years, for example, in the US, the big changes that have occurred essentially were market driven. And it was interesting to me that, albeit subsidized, which is going to be important, the biggest stock story pretty much of the past 10 years has been Tesla. Now, that was encouraged by federal tax breaks, but ultimately I think it's genuinely a market player that has disrupted the entire auto industry. The reference I had to the biggest change of the past 10 years was actually one for Peter, which was that you reduced natural gas consumption. Sorry, you increased natural gas consumption enormously to tremendous benefit in terms of lower carbon emissions, essentially entirely because of price. You know, the US gas price was very, very cheap, and there was there are other issues surrounding renewables and so on. But essentially, the penetration of gas into the energy balance over the past 20 years has basically been market driven.
Yeah, and we're gonna put up some slides, and I'll have Rob speak to them. But please, Peter or Paul, chime in at any time. It'll take a couple minutes, but essentially it has some frameworks for how to think about, sort of this cost of carbon abatement and how you economically get to zero carbon while still having, in fact, while needing a ton of conventional energy relative to what I would say a lot of policy would assume relative to what BP says in its annual report. Go ahead, Rob.
Great. Well, look, I can't resist commenting with a personal view on, the carbon targets. I think we have to kind of resist the idea that carbon emissions go to a certain level because we, set a target, any more than, COVID cases go to a certain level because we have a, zero COVID cases target. To some extent, these policies don't, exist off in platonic never land. They exist because of actual changes in actual markets and the way energy is actually used. And I want to show you some data around that. But let's do it in a slightly different order than the slides we've got here. Could we jump forward by 5 slides and we'll work backwards? Because I think it picks up at a nicer spot. That's the one. So this is my cost curve, and it kind of picks up on what Paul was saying. Let me set the scene for you here. Today, global energy use is about 70,000 terawatt hours per year. That's equivalent to a kitchen toaster running 24 hours a day, 365 days a year for every man, woman, and child on the planet. And it emits about 40 billion tons of CO2. If we do nothing by 2050, we're going to have a 120,000 terawatt hour energy system, and it's going to emit 80 billion tons of CO2. And you can't stop this train because the increase in demand is not coming from us sitting in the United States. It's coming from the 8 billion people in the emerging world who use 1/3 the energy per capita as we do. And by 2050, I have them using 1/2 the energy per capita that we do. And you can't go to these people and say you're not allowed the benefits of modern energy. That's not a route to an energy transition, that's a route to war. So we're going to have 80 billion tons to remove from this energy system. And the good news is we can actually do that twice over. This chart is the cost curve of all the different CO2 abatement options. I think you can decarbonize the entire world for about $75 a ton. That's expensive. That's equivalent to the average person in the developed world giving up about 5% of their income to fund carbon abatement. And that's a lot. But there's certainly no need to make it more expensive than it needs to be by choosing the high cost options on this chart, that would result in 15, 30, 50% of all of our incomes having to go to CO2 abatement. So the way we, model things, and I'd like to go back to the previous slide, is, all the time, oh, that's not the one I was expecting. Can we go back one more? And one more again? Huh, interesting. All right, well, let's pick it up here. All the while, what we're modeling is these different energy technologies, and trying to pick the ones that will get us to net zero most economically. And so here, here's how the chart works out: is my sort of decarbonized bar by 2050. We still have 400 TCF of gas, 85 million barrels a day of oil. I alluded to those numbers earlier. We're abating, we're basically taking coal to zero. We're abating all the CO2 for about $75 a ton. If we go to the next slide, what you'll see, or let's go one more again. Sorry to jump around. It's a kind of bridge of the different categories of how we get here. So, about 20% of the heavy lifting comes from ramping renewables to 20% of the global energy mix. They're going to play an enormous role, but very hard for them to do more than that. The biggest category, on the chart, and Paul alluded to this, is taking out coal and replacing it with natural gas. Remember, a megawatt hour of coal power is almost 1 ton of CO2. A megawatt hour of gas power is 0.35. Then we have the efficiency gains we all know and love, the Teslas of the world, that they also included in demand technologies. The biggest bar, I just want to say a bit about this, is called carbon offsets. So this year, I've offset my own CO2 emissions about 10 times over by paying a charity to plant 1,000 trees on my behalf. You enter into a legal commitment where they say they'll plant the trees. I think it cost me about $3 a ton. And I just, would like to go back to that cost curve and show you how ridiculously low that is on the cost curve. The cost curve,
Rob,
I think, being one slide on.
Rob, do you think?
Go ahead.
Can I interrupt for a second? I love this slide. And by the way, I'm at fault for messing with your slide deck. I didn't put them all in because people's heads would have exploded for sure. But I tried to put it enough that would let the narrative flow. The question is, in your travels, are you seeing a greater understanding of decarbonization not being linked directly to conventional energy? Is there a broader understanding of this? Is it accepted? Because I think a lot of the narrative really is, if you use oil and coal, we all die. That's kind of, is this message?
This is where it comes down to ideology. So, I really try and deal in data and numbers. If you want to make your head explode with data and numbers, all the charts, all the research we have that's up on our website, so you can make your head explode to its content. But if we just look at the slide that's up, right now, this is the breakdown of that 40 billion tons of CO2 emissions that I alluded to. And let's say you're a company in the iron and steel industry, and you're looking at ways to decarbonize. You recognize that you need to do this, and you have energy companies coming to you and saying, look, you're an energy intensive industry. Do you want to go to all renewables, which is going to be, abatement at $300 a ton? Do you want to go to hydrogen, green hydrogen at $700 a ton? And they're saying, no, we don't want to do that because it's going to make us uncompetitive. And more of these companies that I consult with say, we want to be the lowest cost we can be, because, we deal in an industry with cost curves. If we make ourselves uncompetitive, we could go out of business. But we want to take out all the CO2 in the cheapest way, which is these nature-based solutions. Most directly, if the goal is to avoid wrecking the planet, let's restore nature and avoid wrecking the planet. And so, your question about ideology, if you run the numbers, this is just absolutely where you come out. And the biggest pushback you get to this is, but this doesn't count because we're still using fossil fuels in this energy system. And to that you say, well, yes, we've got a carbon cycle. Man emits 11 billion tons of carbon every year through burning fossil fuels. All the trees in the world take up 120 billion tons of carbon. So it's a cycle. But one of the things that I think is really sad is, and I'll finish my sentence, I promise I'll stop. Is it's just, this debate has become so dominated by lobbying and ideology. The people pushing back on the nature-based solutions, they're exactly the people in the high-cost technologies that are going to get pushed off the cost curve if we do nature-based solutions instead. So it's a snake pit, and I'll leave it there. And I think that's a good kind of break point.
Yeah, and I was going to move to Peter and talk a little bit about carbon trading, and I'll let anyone in the group comment on how possible is it to have these economic solutions without a really fair and hopefully simple carbon tax or carbon cap and trade scheme? Is it pretty difficult, or do you think the market will still take care of itself?
Well, we covered an enormous amount of ground there, but so just give me 30 seconds. The first thing is, oil trading isn't going anywhere anytime soon. Even under the scenarios that you laid out, we're still on the growth phase of oil usage, and that looks like it's going to continue for another decade. So, that has to be considered. The age of oil isn't over, particularly in transportation fuels. There's electric cars, but even as fast as they grow, they can't really replace petroleum engines right now. The second thing that we brought up is the desire for either cleaner or renewables, so low carbon or renewables. And the fact of the matter is, it's there. There is an enormous amount of demand from our customers. We talk to them all the time. We're trying to provide risk management tools. The thing about carbon trading is that it's very fragmented at the moment. Government policies have a very strong impact on them. There is an enormous desire of industry today to develop products that will allow them to offset directly some of their fossil fuel use. So that is real, and that does not come from mandates. That comes from their desire and their customers' desire to reduce. Now, our customers are in the fossil fuel extraction business in large part, and their focus is really reducing either methane emissions or in the case of oil, things like IMO 2020, which is the biggest big bang in oil market trading, where sulfur was reduced by a government international agreement in the use of fuel oil in ships, as an example. So, there's a mix of government policy and direct demand from customers to reduce carbon in their extraction process, which is the first thing that they have to get their hands around, is reducing, for instance, methane production in the US, so methane emissions in the US, in order to make things like fracking more palatable to continue. And that's a very important basic bedrock of the energy transition. We cannot do it, as Paul and Rob have referred to, replace coal with natural gas without large supply basins being enabled to produce and export that natural gas. Natural gas is set to triple in usage globally, while oil continues to grow but plateaus. That's the current projection. So the policy and the carbon trading that develops around that, carbon abatement or trading, has to confront that reality.
Peter, so you think oil will plateau in 10 years or so and then stay flat as emerging market needs grow?
I actually don't make predictions like that. Like you said, there's the short, the medium, and the long-term predictions. All predictions are that oil use will plateau in relatively short order. Short order in the oil industry is 10 years.
I think it's interesting. You're tripling.
For instance, some large companies said it peaked last year, 2019, and COVID was one of the main trigger points for this sea change in demand. Others, the business as usual, see it recovering and then plateauing in 3 to 5 years, right? So there's a mix of opinions. Those opinions don't matter because, look, investment, whether there'll be disinvestment and investment into other sectors, but that's going to create more volatility, misallocations of capital. Like Rob pointed out, if you try to just abruptly take away one sector of the industry, then you're going to create volatility and price risk. So trading is going to remain to hedge those risks.
Yeah, and I think carbon pricing and carbon taxation, it's interesting, we can get to this later, but a lot of the big oil companies are now supporting that because it's certainly better for them than bans, limits, mandates, that type of thing. But let's do one quick question still on oil demand, then we'll transition to negative oil prices and talk about that for a bit. When do we think we'll get back to pre-COVID levels of oil demand? I'll get Rob. It's just a one-word answer. There's no narrative behind it. Just what's your best guess based on what we know about 3 vaccines and the rollout and propensity to travel?
Well, I think we're gonna overshoot on the way back up. So I think it could be by the end of next year we could be back above 101. I'm only allowed a short answer, so I will stop there.
That's great. We'll get to, we'll be filling in the blanks. Paul, what do you think?
Yeah, I mean, I think what we've seen is how dependent we are on oil during COVID. So, if you think about one of the lines I had, I think it might be nonsense, but it's approximately true, was that 92% of the world's school kids were not in school in April. And if you think of the kind of slowdown in economic activity we've had, and then look at the max low and where we are currently on oil demand, estimated we're around 93, 94 million barrels a day right now, which is about 1,000 barrels a second. And you are probably driving more because of work from home, less mass transit, and you're missing a good 4 million-ish of jet fuel demand. So I'm on the Rob side of the ledger.
Got it. All right, well, let's transition to understanding. So oil prices sometimes trade negatively. I think Reuters just came out with an article this afternoon talking about this and what we know and what we don't know. So what do we know about that? How it's not unusual necessarily for futures prices in general to trade negatively. Ethane's traded negatively. Electricity certainly does so regularly. How much of this was a pure supply and demand thing, and how much of it was other factors? jump ball on that.
Well, I would defer this question as of today, actually, to Peter, if he's willing to answer, because there is this CFTC report, which seems to be getting criticism for not doing a good job, which I thought was quite interesting, which examined exactly what went wrong. I think the biggest challenge that all of us face in these markets is that the overriding mantra is don't fight the Fed. And, you know, for your CFA guys, it's all about the cost of capital. If, you know, the Fed is coming back in and buying equities and buying Apple bonds, it becomes very, very difficult for us to establish really what investment patterns would be if we normalize somehow, which we don't seem as if we will. In the specific of the negative prices, I had seen it before with the interconnector gas pipeline in the UK when the price went negative, when they linked that up, probably in about 2002. You just simply supply too much physical commodity to a market that doesn't need it. And at that point, you do have, you know, a physical need in the oil and gas market to put the oil and gas somewhere. And if you run out of storage, the cost of doing that becomes higher than the value of the product and the price goes negative. But I don't know, Peter, you've no doubt got, you probably got half an hour answer on this one.
Sure. So, you know, I had some like 1 or 2 slides on this, but we can just discuss it as well. So what we saw was the fastest and most profound demand shift in history that we've seen. So, you know, we pointed out before that the industry consumes approximately 100 million barrels a day of oil, and 13 million barrels of that as of March was being produced in the US. And almost overnight, effectively in the course of 2 weeks in March, we saw roughly a third of that global demand disappear overnight. The oil industry is enormous and has developed efficiencies over the years that has allowed it to expand in the US very sharply. And then, you know, we've never confronted a demand shock of that magnitude in that short of a time frame. And the industry, of course, runs very efficiently. And in early March, we saw some price signals, both in what's known as the contango, so the price of prompt delivery versus forward delivery, start to expand. The price of gasoline, as you know, the U.S. effectively shut off the use of gasoline with lockdowns very, very quickly. Then refineries shut down very quickly, and all of that crude then was pushed back into the producing fields and into the storage facilities. So it was a knock-on effect that evolved over a 6-week period, and the infrastructure obviously had to price it to put it away. You know, we have, you know, when we talk about negative commodity prices, power prices, for instance, have often traded negative. Natural gas trades negative when the ability to store it in a certain area becomes less efficient. You have to move it. Oil cannot be disposed of the way other commodities can. You know, during the same time frame, we saw farmers dumping milk. We saw fields being plowed under because of inefficiencies. You cannot do that with oil. It's a toxic substance that has to be managed and the infrastructure around that's expensive. So if you take it back to what the market was telling everyone through its price discovery mechanisms and risk management, it was signaling that. Paul actually made a very early call. I think he's kind of not famous for it. Famous might be the wrong word, but a very accurate call in March on this topic. So, you know, the market obviously saw it coming. There were a lot of price signals around that, and prior to the event itself. So, you know, supply and demand factors, at the end of the day, a physical delivered commodity must be delivered, must be taken, must be stored or used according to the rules of the exchange and the prevailing market conditions. And that's what led to the event.
What was the contract volume around those days? I just don't know. Was it extraordinarily high? It had to be.
Well, that's all public information. So clearly there was a lot of trading in the industry, but again, the event, you know, in the months leading up to it, but obviously the fundamentals are what drives this market. The lack of demand for crude in the month of in the coming month of May. So this was in April when it happened. So that's what drives the market.
Are your customers looking at risk differently now that that actually happened? Is any of the customers trying to figure out how to avoid that outcome, or is it essentially?
Well, we talk to our customers every day. Customers look forward. It's a futures contract, right? Forward risk. So all of our customers are, the markets remain robust. They're using the contracts. They're setting up for for hedging their risk in the future, over the coming winter, over the coming years. So use of the markets continues. All of the participants have risks that were identified. Clearly, high volatility environments tend to expose risks that need to be hedged. And I think, oil trading and the markets can continue to trade in a very robust way, a very broad usage and acceptance among all of our customer sectors.
Cool.
It might be helpful just to remind people that basically if you buy a contract for WTI on a given month in the future, at the day of expiry, you have a contract for 1,000 barrels of oil. And what happened on that day is that people didn't have any storage and didn't kind of realize that if you can't flip it forward, which is what everyone typically does, you're going to have to try and find a way to take delivery of 1,000 barrels of oil, which is a lot of oil. To give you an idea, a truck tanker has 100 barrels. So you're due to take 100 road tankers of oil. And the price goes negative because a lot of, for example, retail money in China was very long that contract, Peter. I think it's safe to say, isn't it? There was a lot of speculation from people who probably had absolutely zero chance of taking even 100 barrels of oil delivery because they didn't really know what they owned. And as a result, the price, priced out, as you do in markets, the marginal loser, and the net result was a minus $37 WTI.
What do you think the chances of another negative print in oil versus the chances of $100 print in oil in the next, I'll call it 13 months? So I'll take Paul, I'll take Rob on that, and then we'll go on to OPEC.
No, zero. In the next 100 years, you might see it happen again when everyone's forgotten.
Yeah, but it's not going to happen as long as it's in memory. We've adjusted risk-wise. So your default answer is $100 is more likely than zero.
It does happen quite regularly in natural gas because there's a convenience premium with oil, which is that there's a whole different challenge with taking delivery of natural gas. I mean, 100 tankers is easy by the standards of the oil industry. Mm-hmm. The equivalent quantity of natural gas is a further level of difficulty again. And so with the association of natural gas with oil, which is to say when you produce oil, you get kind of free gas or associated gas, the price can go negative because you want the oil and you just take a negative on the gas price. So, gas price, negative prices in commodity markets do happen. It's just exceptionally unusual in oil. And as Peter highlighted, a lot of people miss that the whole industry is just in time. So we have very little inventory relative to how much is consumed every day. My line, which is kind of nonsense, was that we have 120,000 years worth of gold demand in storage, and we have about 60 days of oil coverage in terms of how much inventory we can handle of this stuff that is essentially constantly coming out of the ground, obviously.
Okay, well, let's move on to OPEC. Thanks on that. And can we put up slides?
See negative prices again?
Rob?
Well, look, I think I'm more interested in marginal cost and what that means for where prices should settle after the volatility of COVID. And my number for global marginal cost is currently around $40 a barrel. That's everything. That's to make a 10% return on the sort of half cycle economics of developing and producing the marginal barrels of shale. Just to give you an idea, to make my supply demand models balance by 2025, shale has to grow 2.5 million barrels a day in 2023, 2024, 2025. That's like 1.5 times more than shale's ever grown before. And that means that marginal cost number is going to reinflate because about 2/3 of the numbers that make up that $40 a barrel, just the price of your sand, the price of your drilling crew, the price of your fracking crew. When an industry like that runs flat out, those numbers will go up. So, you know, I think marginal cost today is 40-ish. I think it's going back up to 60-ish. And, you know, I think we're going to overshoot that on the way back up because there's just only so fast. So to kind of put the same thing that we've been talking about the other way around, I agree with Paul. We've learned from this mistake. We're not going to go and have negative prices again, but we might make the mistake the other way around, where you know, people end up with, well, I need the barrel. I got to outbid somebody else. There's only so many barrels in the market today, and then the price can literally go anywhere. And it doesn't tell you, you know, anything about the long run outlook for the industry. It's just a contract flip flopping around to do with the supply demand dynamics on the day of expiry.
Okay, so we're going to have to go like an extra half an hour, particularly if we're going to cover any other American poets. Rob, that's not your fault. We went on earlier. I love the comments, and I'm going to put up your slide on 2025 shale as well in a little bit. Really quick on OPEC. Next week's an OPEC meeting. November OPEC meetings around Thanksgiving haven't actually been a very pleasant time for investors. If you can put up slide 6 and slide 7, it happens at a time. These are real simple. It happens at a time where production is pretty reduced, and the expectation is that production will stay reduced. The next slide's Russia, and then we can get rid of it. Why do we think, and I'll go back to Paul on this, and then I definitely want to get everybody's thoughts, but again, really quick on OPEC. And I think Peter has a great slide on this, which is the next slide, but let's hold that. Why do we think people are so confident that this is going to be a smooth OPEC meeting? It just has been a terrible bet. I mean, not even to describe it as a terrible bet, we should really unpack our adjectives a little more carefully, but go ahead.
Well, I don't necessarily think it will be, but I think the overarching dynamic here, which is very new, is OPEC plus and some sort of an agreement or entente between Putin and Mohammed bin Salman. So there's an overriding, some sort of cartel agreement between those guys at the highest level, which actually at the previous meeting in April involved Donald Trump, whereby, you know, if you apply cartel economics, they're a terrific thing. Now, if you're very good at marginal cost in the way that Rob is, you realize that if you artificially inflate the price by agreeing not to produce for everyone's benefit, which is the essence of OPEC, is a cartel behavior, you encourage arguably Tesla and certainly competing supply, and the competing supply basically comes from the US E&Ps. However, they've done such a horrible job of making good returns, not least because of the cyclical COVID event as much as anything, but also over-investing because they were really pursuing technology, that industry, the US industry, is on its knees right now, not least from heavy amounts of debt. But the big idea is that I think is that Putin and MBS have some sort of agreement. The twist in the plot is that the Prince Abdulaziz, the Saudi oil minister, is a pretty hard guy, to put it nicely. And Novak, the Russian oil minister, can't stand him. And you're not 7 months away from a major price war. So I think there's quite a lot of risk on Monday, and you know, I'll be putting out a preview of it on my website.
And Peter, do you want to talk to the predictor slide from the CME, and we can just put that up for like 30 seconds, and you can tell us what it means, and then we'll shift over to what the dearth of CapEx is going to mean.
Sure. Predictor might be the wrong word. This is our tool, but so the way this tool works is it tries to translate the market data. So what are traders actually doing in the market? And so right now, you know, we have an analysis that looks at what the option markets are reflecting back to us. And right now, you know, there's a methodology that's on our website that can explain basically how it looks at it. But the market's pretty much calling 83% chance that we'll just maintain the current output cut. That's what the market believes. Now, what's interesting about this, that may be a sort of simple analysis to look at and say, yeah, that sounds right based on the headlines. But if you look back to what happened in March, which was much more exciting, if you can put the slide back up, I don't see it, but on the right-hand side, what you're seeing is that as the as the OPEC meeting in March evolved and the drama that led up to it, I think Paul would agree that was an unusual meeting. What we saw was the expectations got upended, and instead of a fairly, the COVID was just getting started. The demand destruction was underway, but hadn't really reached those severe levels. So there was an idea that there would be some mild cuts, and then there was a disagreement, and we ended up with a signaled increase, and then some forces, market forces really were set loose that sort of were not easily put back in the bottle. If you let the genie out of the bottle, it's a little difficult to get it back in. So what we saw was that the market then reversed back to maintain output. So the market was reflecting some fairly accurate consensus as that week or those 2 weeks evolved. So the market does reveal consensus opinion among relatively informed audiences, and what you can do is, if you analyze exchange data, you can generally see what the market's betting or not betting to happen at any time or another. So our interpretation of this, or the tool's interpretation of this, says that there was a maintain output cut, and then a huge swing when the Saudis and the Russians got into a little tiff, and then back to maintain, and then back to cut, and then down to a cut. So, all those different events were reflected fairly accurately in the market is the point. So,
right. And Peter, has that tool been has it been giving us a similar reading for the Nov 30 meeting for a couple of weeks, or has it moved around?
Yeah, I mean, if you look, it's been very, very stable.
Okay.
So all of this is available on the website. This is public information.
Awesome.
This is not.
And let's go to our next section, which is essentially trying to describe how severe the cut in CapEx has been, not only in the US for shale, but globally. The amount of money we've cut in general in oil spending in the last 4 years, and what exactly does that mean? And with that, I'm going to put up a poll question, which is, in 2022, assuming most of the direct effects of COVID have dissipated, what do you expect the oil price will be? And I'm also going to say we were trying to take this to an hour with 10 minutes of Q&A. It's going to go an hour, but we'll stay 10 minutes after for Q&A. So hopefully that's not too inconvenient for anyone. Okay, so post-COVID oil price, and for the group, while they fill out the survey, do you believe the oil and gas producers will stick to the general pivot in corporate strategy to spend well underneath cash flow, dividends, reduce debt, and return more cash to shareholders? How credible are they? And that can go to Rob, I think, first, and then Paul. We'll start it there.
Yeah, I mean, I think my sense of having followed this debate over the years is that the CapEx budget just lags the oil price by about 6 months. So, my sense is that the answer to the poll might inform what you want to believe on the answer to that question. So according to this, we're going to have moderate increases in CapEx. Do you want to cover the poll, Tim?
Yeah, let's cover the poll real quick. 41% right down the middle, thinking 45 to 55. As a reference point, the prompt closed right about 45 today, I believe. A surprising 31% think 55 to 65. I think that might have been a little less 2 weeks ago. And 17% think over 65 versus 1% under 35. So kind of a bullish group dialing into the oil call. Maybe that's sample bias. I'm not sure. Rob, what oil price do you think, based on what you've seen with oil price, oil spend, do you think there'll be an inflection in oil price pretty significantly? What month and year do you think that'll happen? What's your point estimate on the hot zone of calendar where we might?
Let me just reiterate kind of. So I've got we've all got a model, but I've got a model of supply demand, month by month out to 2025. I think the further out I go in the model, the more worried I get. The reason I get more and more worried is, I've got to make supply and demand balance, and I don't know where I'm going to get the barrels. And so, if you think about the average long cycle project in the industry, it tends to take about 3.5 years from sanctioning the project, pulling the trigger, saying we're going to invest in this project, to the first barrels of oil flowing out of the project. So if oil went to, $200 a barrel tomorrow, the long cycle projects would take 3 years before they came online again. The OPEC stuff can come back pretty quickly, but that's already all back in my numbers, by the end of next year. I've got OPEC basically flat out by the end of 2021. And then to keep meeting the decline rate, that sort of 3-ish% decline rate on base production, I've got to have shale growing 2.5 million barrels a day every year in 2023, 2024, 2025.
Let's put up your slide on that. That's slide 8 in our deck, just real quick. And, I don't think this is really consensus at all.
No, I mean, the reason I think this is because I'm a lunatic. I lock myself in a room every summer and read 300 technical papers from the shale industry. And from that, try and read the tea leaves of whether productivity is going up or going down. And you'll see in the bottom left-hand chart, I have shale productivity continuing to grow at a 5% CAGR. There are people who would literally call me a lunatic for thinking this. My view is if you read the technical papers and look at the things that are happening at the cutting edge, it's going to happen. We're going to get this productivity growth. But I am way out on the end of the curve of what people have in for, what shale is capable of. And so, look, if you had a more moderate view than I do, you're looking at 2 to 3 million barrels a day of structural undersupply in the oil market from 2022 to 2025 onwards. And as Paul alluded to earlier, as been talking about with where contract prices fall, you end up at a point where it just becomes, what's the price somebody's willing to pay to outbid somebody else on that barrel.
And Rob, let me let Paul respond to these numbers. Let's take the slide down.
Paul, tear them apart.
What's that? Yeah. How far above consensus do you think Rob's estimates are? And boy, that would imply if the shale producers, back to the original question, are they going to maintain this dividend, this pivot in business model really at most prices? And how long would you have to have an extraordinary price before they start getting back to their old ways of producing as much?
Yeah, Rob made a throwaway comment to start that segment by saying that, his observation is the capex just rises on a 6-month lag to the oil price. That was a beautifully cynical comment of somebody who has been doing this a long time. And equally, I love his research and what he does to lock himself in a room and be a lunatic, because it's really great stuff. And it is out of consensus, but he's done the work. And I think he's high on demand. If I was to worry about his forecast, I'm not so worried about the supply side. The supply side is cyclical. The reason oil and gas are boom-bust businesses is the demand side has a higher, faster elasticity than the supply side. So you get a COVID and you're just way out of whack and all over the map. And then what you'll see in the other direction is the demand side will come to some extent roaring back or come back. We know that people will fly again. We often cite the example of 9/11, where people thought nobody would ever fly again after what happened. And within 2 years, the skies were booming again. So I don't think you want to get too caught up in the reality of the current. And you want to stick with what Rob's saying about the long term. And it's a fairly consensus view that we'll have another big oil run, assuming that the demand side comes back. One thing that's different this time is that we've seen more bankruptcies in the US. And one of the bellwether companies was Chesapeake, that survived the last big downturn, which was the famous Thanksgiving of 2014 OPEC meeting, where the Saudis essentially went for a market share strategy and refused to cut production because nobody else would. Well, the companies made it through that and actually issued equity successfully through that 15, 16, 17 tape, and then came roaring back with huge growth in 17, 18, 19. But this time we've seen the Chesapeakes go bankrupt, and we've seen several of the players, more of the players, go out of business. Additionally, last time we didn't see any really significant consolidation of the scale that we've seen this year. So we've had Chevron Noble, we've had Conoco Concho, we've had Pioneer Parsley, we've had Devon WPX. If you look at that latter three, Concho, Parsley, and WPX, their reinvestment rate last year was over 100%. That is to say, they were in the old school model of E&P, where they spent more than their revenues, believe it or not, which was why oil service stocks always worked so well, because the E&Ps would actually spend a multiple of their revenues on CapEx in order to grow, on the assumption that we were running out of oil and gas. Now they're very much strategized to do the opposite. So if you look at the reinvestment rate last year of Conoco, it was 60%, and now it's taken over Concha. If you look at the reinvestment rate of Pioneer, it was 90%, which is going to be lower this year and lower again next year. But again, Parsley was over 100%. And the same applies for Devon, which is actually now, like Pioneer, got a stated target of no more than 80% reinvestment. That is, they make $1, they only reinvest 80 cents of it. And that's a huge shift that, essentially means that we'll see quite a significant marginal reduction in those go-go growth guys that essentially oversupplied the market over the last 10 years. Because if you look at the oil market over the last 10 years, US supply growth exceeded global demand growth, which obviously is a huge problem for OPEC and became a major issue, to say the least. Called minus $37 a barrel.
So let's shift over. We kind of touched on that, Paul, with investment ideas / implications with that. We have another poll question. And if you saw me flailing there, a guy was coming up with a light on his hat up my front porch, and it was a mailman. So that was he didn't make any sound. So I was trying to be like, okay. So our next poll question is, we'll kick off the final section. In August 2011, S&P downgraded famously the U.S. sovereign debt one notch below ExxonMobil. Since then, oddly, U.S. debt has been a phenomenal investment, while Exxon share price has fallen about 60% and the dividends above 10. That was probably last week's numbers. It's done pretty well this week. In your opinion, I won't read every word here, but in your opinion, over the next 5 years, will the headline be Exxon downgraded, Exxon survives, or Exxon thrives? The last is a little bit thematic as it relates to the number of interest-bearing bond-like vehicles that are actually inflation protected. So I'm going to close out my little thing there and turn it over to, how cheap are energy stocks right now? And are we really seeing a nice long trade in November, or is it really a fundamental turning point? Any opinions?
We fall into an all-time low versus the S&P 500, and it's very difficult to actually work valuation. This is where all you guys CFAs are going to be, how shall I say this politely? It's going to be very difficult to work out what the true cost of capital is for some time. And that's because essentially the government is just printing insane amounts of dollars, I think crazily. And that is hugely altering the cost of capital. And it's interesting in the case of Exxon because it has now a 10% yield. So that's another way of looking at their cost of capital, which is more simple.
Yeah, so Paul, hold on. Let me just go over the results real quick. So Exxon downgraded 21. Exxon survives 53, but surprisingly, Exxon thrives. This isn't exactly a company that's made people happy the last few years, 26%. So I think what you're saying resonates in that you just don't have any yield vehicles. I mean, MLPs pay out 12%. You don't pay any taxes on it. It's like, they're trading as if the risk-free rate was 8. If you thought the business was stable, right?
And let me give you another line and drop a name. I was chatting to the CEO of Chevron yesterday. And, I was saying to him one of the most interesting lines of the year was that Chevron's IR told me that Chevron had borrowed money this year in COVID for the lowest coupon they've paid in their history. And I said to the CEO, it was a kind of an interesting line. Sorry about my phone. Anyway, so basically the IR told me that Chevron had borrowed, and Chevron has a 130-year history. So Chevron's borrowed money for the lowest coupon in its history. I said this to Mike Wirth yesterday, and he's like, I think we might have borrowed money for the lowest coupon in the history of any corporation ever. And he's not a guy given to making hyperbolic statements, but to give you an idea of the difficulty of deciding how much these things are worth. Now, obviously, the reality is going to be what the oil price is. And if Rob is right on his balance, these things are all going to be four baggers at least.
Yeah. I think, you think about the MLPs. One of my questions on MLPs is there's pervasive recontracting risk priced into them? I've been seeing these models that don't show a useful life beyond 20 years, where their revenues declined 5% a year, and they were fairly valued as of the turn of the month. Is there any risk, if Rob's right, that actually the recontracting risk could swing the other way, where there's a scarcity of pipes because they've stopped building and stopped spending CapEx along with anyone else? And not to pick out, it's just an interesting vehicle along with Exxon or Chevron, just because there's no yield anywhere, right?
I mean, I would put that question to Rob. I mean, Rob, what are your investment conclusions from your super bullish view of oil in the 22 onwards timeframe?
I want to make sure I don't tie myself to being super bullish. I mean, I think we are going to overshoot, 2022, 2023, but I think, just to make sure I haven't given any false perceptions, I'm not some, oil mega bull who thinks we're going to have triple digit oil prices for, half a decade. We could, I think, but I think my base case is that we have a big overshoot in 2022, and then shale does start to grow and normalize the markets. On the infrastructure, it's a really interesting one because my sense is, particularly in the Northeast, people can't get the permits. It feels like the regulators are saying, no, I mean, we're done with oil and gas. We're not giving any more permits for any more pipelines. You have to find ways of being more efficient with gas that's already flowing through your pipelines. And look, in the US, there's scope to do a lot of this. I think what I get people excited about investing in are the sort of non-obvious opportunities around the energy transition. And some of those efficiency technologies are in that bucket. Whereas my view is that some of the kind of best known energy transition themes are almost becoming like bubbles. So,
and going back to the debt, we've got, I think Pemex, the Mexican oil company, Petrobras, I think they've both issued 100-year debt. And we're suggesting to Exxon that they should issue some 100-year debt, because it makes zero sense to me. And you've seen Energy Transfer, I think, offer some very long tenor debt, and it just doesn't seem to make any sense given the shifts that Rob's talking about.
Yeah, no, I couldn't agree more. Hey, Rob, we're going to close out and move to Q&A, but I have Rob's bubble chart. Put up slide 12, please. And this is, Rob, if you can spend a minute on this, and then we'll move to Q&A.
Oh, I thought I was going to get through the whole session without getting myself into trouble. Look, I mean, sell-side analysts or former sell-side analysts were the perfect contrarian indicator. I started my own firm in 2019 to help people find investment opportunities in the energy transition. And somehow now it seems to be all that anybody wants to talk about. But I'm also a big history nerd. And, you see these examples of, in the Dutch tulip mania, tulips were trading for 100 times the income of a typical person. If the average person in the developed world was to buy their energy in $15 per kilogram green hydrogen, it would absorb more than 100% of their average income. There's that famous stat that in the dot-com bubble, the NASDAQ was trading at 200 times price earnings. I've got a basket of 10 energy transition stocks that's up 10 times over the last 5 years, up 3 times this year, none of them generating positive earnings. And so I think there are parallels to be drawn between some of these transition technologies and, investment bubbles in the past. And, you don't want to be naive around this. Bubbles take 4 years to build and 2 years to burst. So, identifying the bubble doesn't mean you can just, decide to wash your hands of it. You have to be more savvy than that. And I think, what we might be going into with the kind of incoming administration is policies that are going to build some of these bubbles. And that makes it a really, really tough landscape to invest around some of this. I have a lot of sympathy with, also as Paul's been alluding to, any investor trying to negotiate this just crazy world right now. But I guess if I was going to leave with one comment, I would rather you don't remember me as the guy who thinks we're going to have $100 oil, although it is possible. I'd rather you kind of remember me as the guy noting caution that some of these transition technologies look a little bit bubble-like, and just make sure you don't get caught in the end of the bubbles where, you know, prices tend to deflate by about 75%, you know, when bubbles burst. And I think that's my minute.
Yeah, Rob, I'll defend your street cred. The first time we met was November of 2014, and oil had fallen from like 80 to, it was probably mid 50s on that day. And you and I were discussing, like within 30 seconds of meeting, how oil would likely fall to 30. And everyone was talking about it basing out,
well, you know, Tim,
that's the long run marginal cost.
I was thinking about that discussion. I was thinking about the discussion as we were talking earlier, because one of the points that I thought was worth making is, you know, there's always so much temptation when prices have been going down to assume they will keep going down forever. And I remember back, you know, when we first met in 2014, and I sort of pinned my colors to the mast, and I was the guy who was the oil bear in 2014. And I remember the culmination of that, going to a meeting in Geneva in February 2016. And I remember the sort of portfolio managers walked into the meeting and they said, well, you're the famous oil bear. They all shook my hands and, you know, congratulated me. And that was the day that, you know, oil prices troughed. And I think, you know, when we have a year with negative prices, you want to be very cognizant that just because they've been going down doesn't mean they've been going down forever. And when we have this, you know, bull recovery, just because they're going up doesn't mean they're going to go up forever.
Well, thanks, Rob. We only have time for probably a couple questions here, and sorry for going over to the audience. Hopefully you found it useful. It's hard to do these things. It's hard to do them over Zoom. So Guara, give me a couple questions and then we'll direct them where they belong.
Sure. Thanks, Tim. We have one question from Jake Barnett. And the question is, what are the core characteristics you would look for in an energy company to be successful in the transition to net zero by 2050? Essentially, I think the question is which stocks to buy, I would think.
Yeah, I would think one thing that we didn't cover is BP's transition versus, say, what Chevron's done so far, and the wisdom of each. Not to narrow the question just to integrated oils.
Well, my view is, look, this is a commodity sector. If you invest in the sector with the same technologies as everybody else, you get a commodity-like return. Where I think you generate excess returns in the commodity business is when you have a better technology. And so, you know, I think that's my answer. Find companies that have a technology edge. The way I do it is I read the patents. You know, I've been just bowled over by some of the shale patents Chevron has been filing. There's this kind of view out there, this old view that the super majors just do shale with more capital, like a sort of big blunt instrument bludgeoning the oil out of the ground. It just couldn't be more false when you read the patents and look at some of the just amazing things Chevron are patenting. You know, ditto on BP and some of their digital technologies. It's real industry-leading stuff. And so I think whether it's solar or whether it's electric vehicle charging or, you know, anything that's commoditized, find a company with a technical edge. And that's where I think the long-run opportunities are.
Let's take another question.
Can I just add to that? I mean,
sure, Paul.
This is, as Robert alluded earlier, this is a very capital-intensive business, and over time, the most single important thing is management quality. And, you know, the redeployment of capital by oil companies, which you'll see from BP's share price, their new transition strategy was horribly received by the market, probably because the market is skeptical about the management's ability to undertake this transition and be trustworthy again about it, probably. And so what you really have to do is identify the best managements. And part of that would be what Rob says about Chevron, you know, the idea that they have superior technology. I was also going to mention a story that you triggered me with about the bear call on oil, where I was in Midland, Texas, and I'd been told to make sure I met the head of technology for EOG. And I was in the, you know, dreadful hotel down there in Midland, and this very dashing tall Indian man walked in, and I'm like, well, I guess this is the chief technology officer for EOG then. But what it reminded me of is that within 20 seconds, we were arguing at the bar or agreeing at the bar about the world's balance sheet. And what he was saying is that the balance sheet of the world is miscalculated because you don't include the Amazon, you don't include the oceans, and you don't include the Permian. So I think from the point of view of CFA holders, you know, some of that outside the box thinking of the kind that Rob is brilliant at in terms of what the true balance sheet of the world here is and the true debt is just something that came up and I thought was relevant for your people as you were talking about Rob's great vehicle. But management quality is the single most important. Who are the best managers in my view? Chevron are very good, Conoco are very good, Oxy are a complete and utter walking disaster. Valero are very good amongst refiners, which is an interesting sector when you consider Tesla and the shift to EV.
Yeah, there's some fixed costs there, maybe.
Yeah.
Do they have anywhere to pivot?
And by the way, you know, Musk is clearly a brilliant manager. You know what I mean? This is not exclusive to oil. I mean, what he's done, you know, in 10 years is absolutely staggering. You know, I know many oil analysts that have Teslas, and I've yet to find one that doesn't absolutely love the car. That's my experience with Tesla.
Gaurav, one more question. We'll see if we can.
Let's get one for Peter.
Yeah, that's what I was going to try to do.
So, you know, we'll see if Peter can answer this one. You know, this is more around the new technological developments. So the question is, you know, there are a few questions on nuclear energy and you know, and the cold fusion. And then there is another question by Rich Excel, which is talking about, you know, how in the forecasts which we have spoken about, what is the assumption behind the adoption of renewables and other technologies? Are you underestimating the adoption rate of the alternative technologies which will push the prices down for oil?
Let's see. Those are two disparate questions. I'm going to take Rich's first, and I might direct it to Peter first, then Rob. With the adoption of renewables, maybe describe some of the trickiness and the costliness, and I would say the increasing marginal cost of those renewables rather versus other carbon mitigation solutions. Maybe if we can speak to that.
Yeah, I mean, it's a great question. If you think about how, let's talk about crowding out. So over the last 20 years, natural gas has crowded out coal in the electricity generation fuel stack, which is effectively how power trades. So power trades now as a proxy of natural gas for the most part. And as global gas markets converge, theoretically so will power prices. So when you talk about the collision basically of natural gas economics versus renewable economics, that will be reflected somewhere in the price curve of power prices. However, gas will be marginal for a significant amount of time, and it's highly regional. So there's a real difficulty in separating it. So it may, in theory, prevent any sort of convergence around global benchmarks on power markets, those types of things. It may make it more difficult to trade and reduce liquidity in general. But what won't is the fact that natural gas is going to be pushed into those calculation functions, because natural gas still has a lot of other sources to displace first. Coal still being a major one. So, you know, how efficient does it have to be and how cheap are these different technologies? That's a good question, but the scale of them matters greatly, because it has to get to a certain point where it can displace gas on the margin. And I don't know if that's, it is certainly going to happen in some regions, but it doesn't look like that's going to happen globally right now, as most of the investment is into gas-fired electricity right now, rather than into renewable. And I guess Paul and Rob would know more about that aspect. But from our perspective, you know, the investment is still into exporting U.S. natural gas. That's what we see. That's, you know, those are huge investments. And there's, you know, the first wave has already happened, the one that started 10 years ago with LNG facilities. And there's a wave 2 that is also happening right now too, where we should be onboarding a significant amount of LNG facilities. And the question is, is the capital still committed to those businesses? And I think that's, again, a question for Paul and Rob, rather than the exchange. But I can tell you there's certainly a lot of interest, but the question is, how do you separate all of these different fuel sources effectively into a tradable instrument? And the answer isn't necessarily clear right now.
All right. Well, we're out of time twice, so maybe Peter, while you're on, just a quick send off. I want to thank you very much. Paul, you want any final words? Rob?
Yeah, thanks a lot for having me. It's a pleasure.
Yeah, thanks for the great discussion. I get the sense we could have gone on another hour, so
yeah,
maybe
I got
we'll
about
do another
40%
one
of my questions answered, so I feel bad for the audience as well. But again, thank you to Peter, Paul, and Rob for joining us this afternoon, and also those who attended today's event. Thank you for your patience with our overage. Hopefully it was useful. A reminder, a replay of the event will be posted on the Society's website and YouTube channel. If you have any questions about today's event, please contact the CFA Society, CFA of Chicago office at info@cfachicago.org. And
actually, sorry, I've started to answer some of the questions there. Sorry, that's why I was distracted.
Oh,
Rob,
okay.
I don't know if you can see them, but there's some written questions. I wouldn't just shut down until we just get through those questions.
Yeah. If you guys are willing to do that, I'll hang out.
Yeah.
I don't know what I'm to do after I already read my disclaimer. It's like the nightly news. There should be a national anthem playing and the flag.
So should we have a few more questions? Is that okay?
Right here, there's some written questions, which I know, like question 1 from Ravi Mishra that's you, right? No, hang on. How does the food industry impact oil price and decarbonization efforts? That's like a huge question for Rob. The main drivers of business valuation in midstream, I can answer that. Please send out the slides. Someone else can handle that. Dual gas generation plants, solar to hydrogen. That's one for Rob. And 2 thank yous. So just a couple for Rob. I was just worried that if you turn it off, those questions might get lost.
Oh yeah.
Does it throw anybody way out of kilter if we keep talking? I've got another 14 minutes until another course. So I'm happy to help. But if you want to wind it up, that's fine with me as well.
I'm happy to keep talking. If Gaurav, what do you say?
Yep, I think why not?
Do you have
Watch out! I can ball for Britain on these topics. So if you ask me, I will happily answer.
I'm not necessarily a dog-free zone in the next 15.
Rob, do you want to answer the first one? How does the food industry impact the oil prices and decarbonization?
You see, that one's coming.
Now, hold on. Did I hear that right? How does the food industry? Is that
right?
I think we should.
Well, I can talk just briefly. We have a large agricultural commodity business as well at CME Group, and these customers are very interested in reducing their carbon footprint. So we have worked with them. There's obviously been an alternative fuel in ethanol, which trades quite heavily. But we introduced, for instance, and it's also sort of non-traditional risk, non-traditional futures. CME, we actually introduced a water futures for California just recently. And that's developed a lot of interest as well, because I think there's a recognition in the agricultural space that that there's not just the carbon impact, but there's a generally environmental impact, and trying to use resources wisely, and that's just one example. So I think there is certainly product innovation that is happening in the food industry or in the agricultural space. And reducing the carbon footprint, again, not necessarily on the actual agricultural commodities, but in the extraction process and in the delivery process. So anything that we can do on that side.
If you'll really let me bore you, there's a whole fascinating thing here around soil carbon. So did you know 1/3 of the incremental CO2 that's in the atmosphere today since pre-industrial times actually doesn't derive from burning fossil fuels? It derives from soil degradation, because every year in the world agricultural soils we come and we plow them up, and it releases that carbon that's in the soil into the atmosphere, and that's about 130 billion tons of carbon. as the US has gone from 4% organic carbon in 1850 to about 1% organic carbon in its soils today. This whole thing is etched in the history of the US, and events like the Dust Bowl, where when you pull up the carbon from the soils dry out and they turn to these black blizzards that cause the Great Depression. There's a practice called conservation agriculture, where you use a mixture of no-till, crop rotations, and cover cropping, and this restores carbon into soil. There are great studies out of Ohio State University showing that over 40 years of doing this, you can get the soil carbon back up to about 8%. So I actually worked on a proposal that made its way through Congress on if we had a $30 per ton CO2 price, the average farmer in the Midwest could make more money farming carbon than farming corn. And it's really interesting because, again, this is where you end up with sort of snake pit of lobbying, where the people who like this policy are the people who want to see the most decarbonization at the lowest cost, and the people who dislike it are the guys in renewables and hydrogen and batteries, because I'm the one's going to get shunted off the cost curve. So there's massive amounts to do in agriculture, and we could even take the direction in the space of precision fermentation, where you make Beyond Meat burgers and take out the 6% of global CO2 that comes from cow farts. And it wouldn't be a proper discussion of the energy transition unless cow farts got mentioned at the end. So there's loads of stuff on this.
I would also observe that there was a question which was along the lines of, is it bad that nobody wants to work in the oil industry anymore? And the oil industry has just done a very bad job of public relations with the occasional disaster. But I think, what bugs me is if you look at the agricultural system in the US, it's sort of a military, it's not some guy wearing a straw hat sitting on his porch looking at the sunset. It's a military industrial operation that's basically an environmental disaster. But, it's the oil industry that gets the bad rep.
Yeah, and I think Rob had a slide on that earlier. And one little fun fact, and I'm trying to figure out where I read this, but I think something like 8 to 10% of greenhouse gases can be attributed to not food, but just food waste. Because essentially, that may be a US-centric stat, but I think it might be global, maybe higher in the US. But you think, what percent of food do you waste, and how much transportation did it take to get it there? So it is it's low-hanging fruit. I mean, it's there's tons of low-hanging fruit on this issue, which it's just weird what garners attention.
Another fun fact to mention, Tim, there is that the used cooking oil, which is now used to produce biodiesel in a lot of refinery kits, could sometimes be more expensive than the fresh cooking oil.
We have a futures contract for that. We launched a used cooking oil future this year.
So it has to be properly certified.
That's a liquid market.
Yep.
Paul, I have a question, not to ignore the audience, but I did want to get to this one. The super majors strategy, what do you think of BP's strategy of reducing oil production by 40% between now and 2030? What's behind that? Is there at all wisdom in that? Forgetting about there's elements that they're doing that are, I think, laudable, but that just seems fairly extreme for an oil company.
Well, I think the backdrop is that they're a European company, and so you can't underestimate, as if you're America located or North America located, how much stronger the environmental agenda is in Europe. And it's extremely strong. And the pressure from shareholders is absolutely tangible. It's also very direct. So basically, you'll see BP's headquarters, they're actually selling it. They just leased it back for a couple more years. But essentially, the headquarters of Shell and BP are kind of under attack, almost permanently by, direct protesters and stuff. So there was a dual effect where essentially they were forced to do this. But the combined effect of COVID meant essentially they had to cut their dividend. And so they sort of had to grasp the nettle, is the English phrase. I don't know what the American equivalent is, but they had to sort of catch the knife and really go all in, which I don't think is as necessary as they believe it is from a European perspective. So if you look at Chevron, for instance, that's, I think, savvy market communication, which is the first thing the CEO says in every meeting is that we need better returns and less carbon, better returns and less carbon, better returns and less carbon. If you look at the actual details around what he's saying, there's almost nothing. There is an agenda to improve, and they are investing in renewable natural gas and some of the stuff that Rob's been talking about at the margin of of renewables and green technology, but there's no commitment overall to do anything other than, try that big picture. I generally support the super majors shrinking and raising returns, right? Their attempts at growth have been value destructive because they do a bad job of it. They either invest in mega projects, which they overspend on, that never make as much money as they said they would. Shell has the most enormous floating LNG project offshore Australia right now called Prelude that costs $16 billion and is essentially not working. It's new and it's not working. And that's $16 billion of shareholders' money. What you can do is not spend the 16 billion, maintain your existing operations well, increase your productivity and shrink and have much higher returns, and then present it as a lower carbon strategy because you're not growing your emissions. And it doesn't seem that complicated to me, and I don't know why they all don't do it. I strongly push them. I'm similar, not as well educated in terms of this stuff as Rob, but I have a similar desire to see us get better. I'm no apologist for the oil industry. And, I really believe that these companies should pursue carbon tax. So my suggestion directly to the CEO of Exxon is you got to do a mea culpa, say that you now believe that it, and by the way, they do. That's what's crazy is Exxon actually does believe that human activity is lived.
Wouldn't a carbon tax, as opposed to the myriad of other subsidies, and wouldn't it be bullish for integrated oil companies more so than almost any other kind of company? I mean,
the first thing you do is you'd switch all of the coal in the US to natural gas.
Right.
So I ended up with something like a 13 BCF a day gas push just from that measure. So it benefit hugely.
And last I checked, they sell gas.
I mean, this is not what you'd expect to hear from the COO of ConocoPhillips, but I was at dinner with him, and he thinks that what you should do is put in a carbon tax straight away and send a check with the revenue to everyone with a social security number in the US.
Yeah. I worked on a proposal for that. And you can get there. You can decarbonize the entire US by 2050. You attract $300 trillion of incremental investment. And you create something like 300,000 jobs in the process. I actually went through and added up category by category by category, and that paper went to Congress. And there's serious people talking about this, and you could do it with a carbon price about $75 a ton. So I think this is going to be.
And it means that if John Kerry is going to live in an 8,000 square foot house or whatever he lives in with 14 cars, all of them SUVs, whilst telling us to save the world, at least he's going to pay the true price of what.
Yeah,
right?
I think the challenge with this stuff is, look, I mean, I don't want to kind of get into politics, but
go for it.
So my sense, this is a broad generalization, is that people who are affiliated with the Republican Party are more in favor of CO2 tax and a sort of level playing field that would decarbonize the entire country, where the lowest cost technology wins. And broadly, people who are affiliated with the Democrat Party prefer another option, which is we identify kind of our friend technologies, and that one gets a subsidy, and that one gets a subsidy, and that one gets a subsidy. And, we just sort of pick the technologies we want to incentivize, and the others, if, you might be like a Rankine cycle engine that recovers waste heat from an industrial process. Well, bad luck, no carbon subsidy for you. You're not one of the chosen ones, right? And
right. You're actually working on your patent instead of lobbying.
Exactly.
It's going to be a disaster. I mean, the thing was written by AOC in its origins, and it just really doesn't have a huge amount of scientific basis for it. Václav Smil is the ultimate energy analyst, and he said that the whole Green New Deal and everything surrounding it is just complete nonsense.
Yeah, it really is a shame, because if it's to Rob's point, you can program Rob to whatever your opinion is on carbon neutrality at what date and all that, and you can have an intelligent discussion on how to economically get there. But if you're not having that discussion,
well, I urge people to
no, but that was the discussion. I've had the discussion, and the discussion is, it's a really interesting plan. It does a lot, but my lobby groups aren't going to like it.
Yeah.
And I just think it's really sad that this debate is now driven by who lobbies the hardest, who's got the biggest fangs in the snake pit. And can't lose sight that the goal here is to get to net zero at the lowest possible cost. And before I get myself in trouble, I think I'm going to have to go.
Well, let
okay,
me
good.
you, Rob, you've got to, further to the snake pit, you must look up the cobra effect, right? Of misguided, you know it?
I don't know. No, what is the cobra effect?
Basically, the British put in a cobra reward, so that if you found a cobra, if you hunted down a cobra, they would pay you for it. And ultimately, they had tremendous success in reducing the number of cobras in India, in that region, until suddenly more and more and more cobras started turning up. And it was completely out of control. And then what they found out is that the cobra hunters had started breeding cobras. They canceled, this is where it gets great, they canceled the cobra bounty program, and the hunters released all the cobras.
Right. On that note, great to see you guys.
Rob, thanks again. Peter, if you're still on, thank you.
I am.
And
thank
Paul,
you.
great seeing you. Thanks to the CFA folks. I'm not going to do another formal sign up. This was CFA Education After Dark, apparently.